I've been reflecting about how many times people say they cannot invest too much money, therefore they cannot get rich. And there's always a phase of disbelief when I tell them the capital that you're going to actually invest and put to work, the money that you separate to invest, that's only one of a few factors that affect how much it will grow. There are two equally important factors that don't have much to do with that. One of them is how long are you going to keep that money invested, and still another factor is how much will that money be compounding or growing during this time, right? If you say I'm gonna put $1,000 invested for 1 year and it will grow 6%, so that's very definite. But if you left 2 years and it grew 6% in each of the years, right? Or if you left the same $1,000, you didn't put any more money, you left it 1 year, you left it a second year, then you left it a third year, and let's just imagine it also grew the same 6% that third year, so you're giving more time for it to grow. That is what we call compounding. Because see, in the first year, you had $1,000 to give you extra 6%. You had 1,000 trees to give you fruit, right? Then out of those 6%, that fruit that came from your tree, pretty much, right? The outcome of your investment, you purchased a bit more trees, right? Not as much as 1,000 of them, but how much was 6% of 1,000? $60. So in the second year, you had $1,060 or 1,060 trees growing. So in the second year, when you've completed 2 years, not only you got 6% out of your own 1,000 again, you also this time got 6% on the $60, which were the 6% of the first year, right? And then it kind of gets fractal, right? The third year, you had the 1,000 plus the 60 plus what had already come out of those, so it's called compounding, because every fruit that you're able to harvest from the trees you planted will also give you a bit more trees. Each fruit has, some seeds. Some seeds will stick. It's a metaphor, of course, but the power lies in what's similar. That a portion, that's why it's percentual, right? A percentage, that's a fraction. That's why some people also call it fractal, right? Not only your original capital, but all of the capital that your capital made will continue growing. That's then three levers, three factors, right? One is how much money you invest, how much money you plant, right? Then are you going to cut the tree, or are you going to leave the tree generating more fruit repeatedly over and over with each cycle, each new season, right? You can leave that tree giving you fruit 10 years or 20 years or 30 years. So the longer you leave the tree planted, the more fruit will come out of the tree. And you know, the seeds, if you replant, right, you can eat the seeds with the fruit, or you can plant them again, so you have more trees giving you fruit and seed. It's pretty much like that. That's why sometimes they call seed capital, right? Before you have a tree, you have to plant it. It's the beginning of a tree. Yeah. And honestly, when we say 6% or whichever percentage of growth or yield we get in a year, it doesn't mean it's always going to be the same. On the contrary, it's rarely the same year after year. Even if you choose fixed income like GICs in Canada, you know, guaranteed investment certificates, those are pre-fixated. Typically, you know they will offer you 3% or 5% after 1 year, sometimes up to 2 or 3 years, right? Very rarely people buy that for longer than that, because it's predetermined. So you don't know how much inflation is going to be, you know, how much prices are going to increase for everything that you buy, you know, bread, milk, eggs, vegetables, what else do you buy? Meat? Do you buy flour? Do you buy coffee? Do you buy rice? Do you buy pasta? Do you buy fish? What is it that you know? Do you buy fuel for your cars, for your motorbikes, for your airplanes that you have, for your boats? So it can be a good deal, it can be a bad deal, but typically people who offer you a prefixated rate, they can only offer so much, because they know in reality probably the markets are going to yield more than that. They're going to keep some for themselves. Of course, why would they promise you something that they didn't know they could have to give you back, right? For example, banks, yeah, they are charging much more on the loans and the credit that they extend to you than they will pay you on your deposits. That's that gap, that difference is called the spread, the banking spread. It's a way of understanding why prefixated is not really a growth machine. It's not. It's a preservation instrument, right? It's you don't want your capital to lose purchase power, because prices are going up. If you keep the same amount of money, you cannot keep up with the prices. So, but you don't want to risk it going down. This is why it's a timid and snug, tight fit, you know, because that's for preservation of capital. Growth is when you're getting things that either pay you a constant dividend, or whose price will increase strongly because you're running risk. You don't have a guarantee that the price will even keep the same. It could go down, and typically it goes down in the short term. We've been seeing that in the beginning of 2025, in the beginning of 2026. We've had too many weeks of that happening, where people get discouraged because the prices are down. Honestly, it's just a discount, right? You don't want to be selling, you want to be buying when the price is low, but you don't know. 2 years now, we know it happened in the months of March, April. We cannot program that. So volatile investments are the ones that typically grow, because they are not fixated, they're not stuck right in one place. There's like a type of special type of tree. You don't know exactly how many meters that tree is going to grow, or exactly how many fruit is going to come out of that tree. Maybe it's a bad year with bad weather or bad soil or some type of bug and you don't have crops. Your trees or anything you plant doesn't give you yield. It doesn't yield a good harvest, right? It happens. But okay, I've explored a bit of these three factors or levers, right? This is why we say when you're looking for growth, you gotta be looking for long term. It's money that you will not need in 1, 2, even 3 years, because it's short term, and in that period things can end up poorly. Prices could be down, right? But typically in longer periods, when you invest in volatile equities, in growth stocks and funds, could be exchange traded funds, the ETFs, or mutual funds, they are similar in that in the long run they have much stronger yields than fixed income, especially prefixated income. So how much you put in, how many years you're going to leave it invested, and the exposure to growth, the exposure to volatility, right? How mobile, how malleable will you allow your capital to be deployed? You know, you want less certainty with a bigger potential in the long run. You get rewarded more for running this uncertainty, so-called risk. Then again, risk is an entire chapter as well, because we only think of risk in terms of keeping the same price, not losing capital, but that's short-sighted and simplistic definition. There are more than 10 types of risks in investments, and whoever has held positions in equities and opted to receive correspondence, updates, documentation from the fund managers or from the companies if it's a single stock. You might have seen the disclaimers, you know, all types of risks. That's for another video. Thank you so much for watching this. Keep sending me your questions in the messenger there. You get my email once you subscribe to the channel as well. You can also leave it in the comments of the videos if you feel that it's fine for you. It's definitely fine for me. Some people sent on LinkedIn as well. You got my link to my profile there. Just look around, you know, on my YouTube profile, you'll find the LinkedIn profile. Well, I have 2 names only, and only I have these 2 names, Diego Rimas. So that's it. That was it for today. 3 factors that impact your long-term growth investments. It makes more sense when you say them together, right? And homework, think how much of it can you control, how much can you influence each of these factors. The time horizon might be the easiest, because you cannot control how much you're gonna yield from that investment, and the savings rate, or how much capital you're constantly investing, you know, because you should not spend everything that you earn. you should always keep some and invest, that you have influence, definitely. Think about that. See you next time.